The taxation of cryptocurrencies can be complicated. This is because, depending on the circumstances, you might or might not have to pay taxes. Knowing your tax obligations in advance will help you avoid unpleasant surprises when the IRS comes to collect from you if you own or use cryptocurrencies. But not to worry, we've done all the work for you. In this video, we will tell you all you need to know about how cryptocurrency is taxed, how you should report your crypto income, and how you can legally reduce your crypto taxes. With that said, let's get right into it. Why are cryptocurrencies taxed? Cryptocurrencies are taxed even though they were intended to be decentralized and unregulated by governments. The Internal Revenue Service, IRS, claims that the majority of cryptocurrencies are convertible virtual currencies. In other words, they serve as a store of value, a medium of exchange, a unit of account, and an option B for actual money. So, whether you are using your coins as an investment or as cash, as long as their value has increased or even decreased, you may be required to pay taxes. What you need to know about taxation on cryptocurrency. No one would request a tax from you for simply holding cryptocurrency. The IRS typically taxes cryptocurrencies like investments and property and not as currency. This means whether you sell coins or use cryptocurrency to make a purchase, all of your transactions are subject to the same tax laws that apply to other capital gains and losses. And when your business payments come in the form of crypto, they are subject to a business income tax. Take, for instance, you get paid in Bitcoin. You will have to pay income taxes on its current value. And likewise, you get taxed for every profit you make from selling cryptocurrency. Now you may start asking, how do these cryptocurrency taxes work? What percentage would be deducted from my profit as tax? Hold on, we are getting right into that. When you acquire and sell cryptocurrencies, calculating your tax is more complicated than just comparing your net proceeds to your cost basis. The amount of time you owned it and how you obtained it also need to be taken into account because it affects the kind of capital gain or loss that will be applied. This is because your short gains or losses can be further classified as short-term or long-term, depending on how long you held the coin. Short-term gains or losses usually occur within a year and are taxed at a range between 10 and 37%. If you purchase and sell crypto within this period, you will either record a short-term capital gain if it's sold for more than you bought it, or a short-term capital loss if it's sold for less. And just like the tax rates that apply to ordinary income, such as earnings, salaries, commissions, and other earned income, this is also applied to these types of transactions. On the other hand, long-term capital gain or loss is applied after a year of holding cryptocurrency before selling it. It is the type of tax applied when you purchase crypto, hold it, and sell it after a year. Long-term capital gain is taxed at a range between 0 and 20%. Now, numbers don't lie, and you might have noticed that the rates are typically lower for long-term gains compared to short-term gains. Bear in mind as well that the highest tax rates possible are usually applied to those with the largest annual incomes. Now, remember, we mentioned earlier that how you obtain your crypto is another factor that determines how it is taxed. Well, how you use it also matters. We all agree that crypto is not just about buying, selling, and exchanging. You can also use crypto to purchase items. While buying items and paying with crypto can be good and convenient, it comes with two prices. Number one, you will incur a sales tax for simply making the purchase. And number two, supposing there has been an increase in the cryptocurrency value since you purchased it, you will also be charged with a capital gain tax. When it comes to how tax is applied for selling crypto, a perfect example is when you exchange it for fiat money. The capital gains or losses are calculated when you sell your cryptocurrency for cash by deducting the cost basis from the market value at the time of the transaction. The same goes for when you exchange a coin for another. In the case of crypto mining, tax is immediately applied to every coin obtained. You don't have to sell or use it before it becomes taxable. In these situations, it is taxed depending on the value of the cryptocurrency on the day you receive it at your regular income tax rates. And if we examine things closer, you will agree that purchasing items with crypto and exchanging them also results in immediate taxes being applied. Now that you know the ins and outs of crypto taxes, the next step would be how to report your taxes. How to report your crypto tax. The first thing to remember when reporting crypto taxes is that there are no legal ways to avoid it unless you don't use it. Any earnings or losses you make from buying and selling crypto must be reported to the IRS. This means ensuring that every crypto transaction is recorded, including the amount spent and the cryptocurrency's market value at the time it was used. Fortunately, many crypto exchanges offer transaction reports that list all your purchases, sales, and exchanges made on your account. Gathering this report is especially easy if you do all of your crypto transactions on one exchange. But if by chance you use multiple exchanges, crypto credit cards, or even crypto wallets, then you must obtain a report from every single one of these. Thankfully, there's another way out in this case. You can manage your digital assets and access your needed tax information with the help of platforms like TokenTax or CoinTracker, which offer transaction and portfolio tracking. So after successfully getting all you need, the next step is reporting them on IRS Form 8949, Sales and Other Dispositions of Capital Assets. After all is said and done about crypto taxes, there are still ways to legally reduce how much tax is applied to your transactions if you know your way around things. This brings us to the next section on reducing your crypto tax. How to reduce crypto tax. One way to reduce the taxes applied to your cryptocurrency is to hold on to your digital assets for more than 12 months. You typically only have to pay cryptocurrency taxes once you sell them. As long as you are holding it as an investment and it isn't producing any revenue, no one cares. You can avoid paying taxes by not selling any of your digital assets in a specific tax year. Another option is to offset your gains with losses in a technique known as tax loss harvesting. Let's make it simple. Say you suffered a $1,000 short-term loss and made a $2,000 short-term gain, and at the same time a $3,000 long-term gain and a $5,000 long-term loss. When this happens, you would have a $1,000 net short-term gain and a $2,000 net long-term loss, which can then be summed up to a net $1,000 long-term loss. Using this offset principle to your advantage gets you a claim of up to $3,000 annually, with all excess losses moved to future years. Other ways to efficiently reduce the tax you pay on cryptocurrency include buying or trading crypto in an IRA. That means an individual retirement account, making donations, declaring your digital asset as income, and many more as you can legally find. And on one final note, the right crypto tax platform gives you all the help you need to manage your investments. You can trust a solid platform like CoinLedger to manage all your gains and losses. CoinLedger also helps you save time by easily keeping track of all your tax obligations and filing your cryptocurrency taxes.
Alright guys, give this video a thumbs up if you learned something new. Share and subscribe to encourage the work that we do. Don't forget to check the description below for our Telegram channel link, where we would be sharing fascinating crypto information. Till I see you again, stay curious and keep learning.